interest rates from the investor's perspective. When their Uncle Steve disappeared, Boudica, Olympias, Titus and Zenobia decided to divide up the inheritance and invest the money in different ways. Boudica's castle was frequently attacked by dragons. She wanted her money somewhere so that if a dragon just showed up again one day, she would have very easy access to it. She considered an access account. The disadvantage was that it provided effectively no interest, but the advantage was that she could access the money whenever she wanted. She also considered a savings account, which provided a little bit more interest. The money was a little bit harder to access, and getting the bonus interest was based on meeting certain conditions, like adding in a certain amount into your account each month. Olympias knew that she didn't need her money straight away. She wanted to build a tower, but at a fixed time in the future, so she considered a term deposit. The interest rates for term deposits vary. The longer that you have the money in for, and the more money you put in, the higher the interest rate. But your money can't be accessed for that specified period of time. And it also requires a minimum deposit, which could be quite substantial, of around $5,000. Titus is going to utilize a different strategy. Because he didn't get as much money as he expected from the inheritance, he's going to borrow more money to invest. The first thing that we need to know about borrowing money to invest in a bank is that the interest rates are always higher for loans than for investments. Why might this be so? Let's say Titus was able to go to the bank and borrow money at a low interest rate, and then was able to return and invest that money for a higher interest rate. With the extra money that he's now gained from the high interest rate, he'll be able to borrow more money. He would then be able to return and invest that higher amount, and then keep borrowing more and more money and investing more and more money in the bank. Eventually the bank would go broke. Titus is able to borrow money at the bank at 5% per annum, and he's going to look at investing that money elsewhere. But what is he required to break even? Is it 5% per annum, slightly higher than 5% per annum, or significantly higher than 5% per annum? Let's look at the example where Titus borrows $100 and invests it. Both what he borrows and what he invests have the same interest rate. After 1 year, his loan interest is going to be $5. His investment return is going to be $5. So he has in a way broken even, but not so fast. There are some things that we need to consider. For instance, loans and investments usually attract fees. But more than this, earning extra income is taxable. If Titus's income tax rate is 30%, what this would mean, of the $5 that he earned, $1.50 is paid in tax. So for him to earn $5, he would actually really need to earn $7.14. So what this means, to pay off the 5% per annum loan, he would actually need a 7.14% investment. Zenobia has the revelation that paying off debt is like an investment. Paying off debts have some advantages. For instance, debts tend to be stable and predictable, unlike investments where you may have significant returns, but you also may lose a lot of money. You can also be guaranteed a good return by paying off your debt. If you've got multiple debts, pay the debt with the highest interest rate, not the highest debt. Zenobia has some debts. She's got a $100 debt that's paying 20% per annum and a $300 debt at 10% per annum. And she can pay off $100 each year. So one strategy would be to pay off the largest debt first. The other one would be to pay off the highest interest rate first. With strategy 1, after 1 year, she owes $200 at 10% and $100 at 20%. So the amount of interest owed after 1 year is $40. If we follow strategy 2, which is paying off the highest interest rate, after 1 year, you have $300 at 10% per annum, but nothing at 20% per annum. This means the amount of interest owed after 1 year is $30. If we look at the strategies side by side, we can see that paying the debt off that has the highest interest rate leads to paying less interest overall. And you can see the total interest is quite different at the end. Boudica, Olympias, Titus and Zenobia meet up to discuss their various investment strategies. But they're a little bit surprised when Steve rocks up unexpectedly, asking about where his pot of gold is. Maybe they should have had a look on the note on the fridge that said that Steve hadn't disappeared, he's just been at a 7-day yoga camp. So to recap, access accounts are good for accessing money, but basically pay no interest. Savings accounts have more limited access, but will provide slightly higher rates, provided that you abide by the conditions. Term deposits have a higher rate of interest, but your money is locked away for a specified period of time. Due to tax, borrowing money to invest means that you have to earn significantly more than what you borrowed. The best returns can usually be achieved by paying down debts. Debts with high interest rates should be paid off first. There are always exceptions to this, and this video doesn't take into account your own individual circumstances. Thanks for watching. Please subscribe and hit the like button. Please leave a review and a comment. I'm not a financial advisor. I'm an experienced mathematics teacher with a passion for teaching financial literacy. Please read the disclaimer.